but it all has consequences, and I think we are starting to see the consequences of.
History is about to repeat itself with a heavy blow to the real estate market. Yet you will not believe the drastic decision Warren Buffett just made, despite warning us. The narrative turns dark with Brookfield Corporations, one of the world's largest real estate companies, relinquishing properties in Los Angeles due to skyrocketing maintenance costs and plummeting occupancy rates, leading to a jaw-dropping 50% loss in property value. Warren Buffett's recent $700 million investment suggests a strategic move to weather the commercial storm. It all started with the bubble era. This period, leading to the 2008 market crash, was characterized by an upward boom in housing prices, as seen in the chart, primarily due to easy access to loans and mortgages. In 2006, Warren Buffett had something to say about this. He warned about the dangers of this speculation and likened the housing market price action to day trading, a risky practice that was prone to dramatic crashes. Over the years, there has been a constant rise in the prices of houses, which was, at one point, interrupted by the pandemic. Many investors are sounding the alarm once again, suggesting that the bubble era could be upon us. But the target for this is not the residential real estate market. The cost of acquiring a newly constructed home has fallen dramatically. The average sale price of houses sold in November 2023 stands at an estimate of $488,000, and at the end of the month, these prices dropped to a low of about $450,000. The prices of existing houses, on the other hand, seem to be on a gradual rise. But why? Supply and demand play a vital role in this. Understanding supply and demand in the housing market can be linked to a term known as the month's supply. It estimates the total number of months that would be required to sell the current inventory of property while paying attention to the rates of sales of units of the property, in this case, real estate. So, a month's supply value of more than 6 indicates there is an abundance of supply relative to demand, which signals a potential decrease in prices. A value of less than 6 indicates a limited supply of homes relative to demand, which causes an increase in prices as depicted in this chart. At the moment, the construction market month supply value is valued at 7.8%, which is an indication that the supply of homes is greater than the demand, thus causing a surplus of homes waiting to be sold. This causes a significant drop in price in the new home market and has affected the price with a 17.8% decline, according to metrics. Despite the numerous reports of falling prices in new homes, there are counter-arguments that the sizes of the new houses are shrinking and the price is not actually reducing. And this argument might hold some truth. Take a look at this chart. From the chart, you can see that the sizes of houses are decreasing. In 2016, the median square footage of new housing has an estimated value of 2,500 square feet, and today, the estimated value is 2,200 square feet. This shows a huge decline in the house sizes over the years. However, concluding that the price decline is due to the house sizes would be missing the bigger picture. Between October 2022 and October 2023, there was a shift in the average house size from 2,300 square feet to 2,200 square feet. The real power is in the median sales price, which was adjusted for the square footage, revealing a decline of 10.2% from its peak in 2022. This, in fact, is one of the biggest drawdowns on record, which highlights a genuine price correction that goes beyond the adjustment of size alone. So, this shrinkage conspiracy is only true to an extent. New home prices are actually falling, and although the smaller sizes of these new homes play a role, the main cause will be a shift in the market forces. Cities like Miami and Atlanta are witnessing an increase in new homes. At first glance, this might seem like a positive thing, but the falling prices in these new developments can cause what is called a ripple effect, which will affect the prices of existing homes as well. Comparing this to more populated towns that have minimal new constructions, like New York, the absence of these new constructions that compete for buyers puts sellers at an advantage in the existing market. Warren Buffett and Charlie Munger, at the 2023 Berkshire Hathaway meeting, were asked a question regarding a Financial Times article where Charlie Munger spoke with caution about an impending storm in the commercial real estate market of the United States. He was asked to elaborate on what was happening in commercial real estate and how bad the losses would be. Charlie Munger addressed the concerns about downtowns and said that he anticipated a significant and particularly unpleasant decline in activity, especially in office spaces across the United States and around the world. He implied that this was related to the problem of low rates of vacancy in commercial real estate properties. He also mentioned that the country would get through it, but it might have to involve a different set of owners. Warren Buffett then gave his opinion by agreeing with him and mentioning that buildings do not go away, which sheds more light on the continuity of physical structures despite a change in ownership. Charlie Munger then further mentioned that the owners of the buildings change, which signals that commercial real estate owners with high leverages will possibly begin to default on their loans, which will cause banks to take over their properties and sell them to other buyers. The issue with commercial real estate companies that buy real estate is that they tend to borrow as much as possible without any personal guarantees. This will have an adverse effect when the market has a decline. Unlike homeowners who are invested and attached to their properties emotionally and financially, these commercial real estate companies do not hesitate to get rid of their property when they are faced with financial issues. This could create a cascade effect, with unpaid loans affecting banks and triggering a cycle of changing ownership of buildings that are no longer of value. When a homeowner gets rid of a property, they no longer have a place to stay, but a commercial real estate company getting rid of a property would just be termed eliminating bad investment. This ultimately means that when borrowers are not able to pay back their loans, the banks end up confiscating those properties as collateral. The interest rate of mortgages, which was 2.5%, is no longer the same today due to economic changes. When these properties come up for renewal, the investors will start to realize that the economic situation does not allow these previously acquired buildings with low mortgage rates to be profitable. Because of this, the mortgage payments increase and the income streams from these buildings decrease due to several factors like remote work and economic slowdown. This then causes a ripple effect because the combination of an increase in mortgage rates and lower income from these houses can make the building less valuable. Most of the buildings, after a while, would become less in value than the outstanding loans, which are yet to be paid, putting several investors in a position where they own properties that are worth less than what they owe. When a property owner is in possession of a property that does not sum up to the outstanding loans, and there isn't sufficient income to support the mortgage payments, that would spell disaster and an ultimate loan default, leading to a huge decline in the overall value of the real estate market. Warren Buffett believes that the real estate sector is more equipped to handle an economic crisis compared to 2008. Deciding whether to buy a home or not depends largely on several factors, especially the market that has been targeted. In the case of a significant number of newly constructed houses and an increase in supply, the buyer would be at an advantage. This means that home builders eager to move inventory will be more susceptible to offers. The price in those areas might experience a decline due to the competition among sellers to source for buyers. In an existing home market, the overall market usually experiences high valuations of houses. A decision to buy might indicate buying at a potentially inflated price. Competitions would be stiffer, and it might be more of a challenge to secure offers. So, this begs the question of what seemingly drastic decisions Warren Buffett made. Recently, Warren Buffett's firm made an investment of $700 million USD in the real estate market. But why? Well, as I mentioned earlier, the storm brewing is a commercial storm and not a residential one. The shortage of houses is likely to cause a long-term increase in prices of residential houses, which would put home builders at an advantage over the next 5 to 10 years. Despite the fact that there might be a short-term dip in the residential sector, homeowners would still be at an advantage. This is because commercial real estate is more vulnerable to the brewing storm, and housing shortage limits the supply of houses and ensures prices are at an all-time high. Short-term corrections are possible, but the overall trend is expected to be positive for residential homeowners, although the same cannot be said for commercial estates. If there is a new development, trust that you will be the first to find out on this channel. So, don't forget to subscribe so that you do not miss out on anything. Feel free to drop your comments below, share your thoughts, and let us know what topics you'd like us to explore next. Thanks for watching.